Well, hello and welcome to our webinar, Where Do Hotel Asset Values Go From Here? We are thrilled to have you join. We have an exciting lineup, an exciting discussion, a timely discussion, and you've joined the right webinar today. As we have everyone log in, we're going to ask you to get to your chat pretty quickly and chat in where you're dialing in from, your location, and then also your name. Would be great to have your name in the chat as well. So again, welcome. We'll get started here shortly as we have folks log in. In addition to that, a couple of housekeeping notes that we'll go over. The session is being recorded, and by virtue of your registration, your attendance, we'll be sending out the presentation, the discussion following the call. And we want to give you a couple of tips just to maximize your screen, turn up your volume. We recommend using the gallery view or side by side. We will be pinning our speakers so that you can see those who are addressing the questions. And then, of course, we are going to be taking your questions. So please feel free to chat in questions throughout the conversation. We'll be taking some time throughout to pause and to monitor those chats and address them. And you can also use the Q&A feature as well. We'll be monitoring both. And remember, when you do send in your questions, please do send them to everyone, or you can send them to all panelists or even a specific panelist. So with that being said, as a reminder, please do chat in where you're dialing in from and your name. Welcome to our webinar, Where Do Hotel Asset Values Go From Here? We're going to get started today. This webinar is sponsored by SalesBoost. We are thrilled to host this webinar again. This discussion has been ongoing with this expert group since 2020. So SalesBoost, we are a skill-based learning platform for hospitality. We are the most advanced skill-based learning platform. And it is our goal to help challenge teams to perform at their highest level and find more revenue. You can learn more about SalesBoost at salesboost.com, or you can contact us at info@salesboost.com. Let's go ahead and introduce our expert panel. We're absolutely thrilled to have this group together. And these folks certainly have the background, the foresight, the expertise to provide a really engaging discussion today. First, the leader in charge who really orchestrated the group together, Dr. Donald Wise. He is the founder of CBRE Hotels and co-founder of Turnbull Capital Group. Dr. Wise is such an icon in the industry. Unfortunately, he's not with us today. And so in his place, our founder of SalesBoost and CEO, Gretta Brooks, is going to be moderating the panel today. Gretta is also going to be contributing to the discussion as well as the moderator. We are thrilled to also welcome Greg Mount, founder of Victory Hotel Group. Greg, thank you for joining us today. Glenn Callison, he's shareholder with Musch, Hardt, and Hardt. And thank you again, Glenn, for joining us. Ned DeLorme, we are thrilled to have you and your expertise acquisitions with Jupiter Holdings. And of course, we have Stacey Nadolny with HBS. She's a managing director. Stacey, we look forward to your expertise. This is Stacey's first time joining the club, joining the discussion, and I know you've got a lot to offer. Paul Novak, managing director with Whitman, Peterson. Paul, thank you very much for joining. Understand you actually also are in the midst of opening a hotel today as well, ribbon cutting ceremony and all. We can't wait to hear about that. And William H. Reynolds, Jr., Senior Managing Director with MCS Capital, the Marcus Corporation, otherwise known fondly as Bill. Thank you so much for joining again, Bill. So as you can see, we have a rock star panel. And, you know, it's been since January 2021 since the group has been together. And today we were able to receive the latest data through February 12th from STAR. And what Star is saying is that the US weekly hotel performance advanced to its highest levels since December. So good news, right? Occupancy at 54.6%, down 14% compared to 2019. And then average daily rate, this is interesting, ADR, actually up 1.3% at 133.72, largely due to Super Bowl. And then RevPAR sitting right about $73, still down 12.9%. So with this data that's come through and all of the other information that the panelists will discuss today, we have a kickoff question. We'd like each panelist to address this, and that is, are there signs of normalization? Based on that, I'm going to kick it over to Greg Mount to address this question for us first. Greg.
Hey, good morning, Gretta and Andrea. Thank you very much, and we appreciate SalesBoost hosting this for us. I think from an overall perspective, the jury is still out a little bit on that. At this point right now, I think that you're seeing the economy, mid-scale independent hotels achieving actually above 2019 RevPARs, but you're still seeing luxury upscale and upper upscale hotels down anywhere from 9 to 21% of 2019. So I think that the jury is still out on that, and you're going to see it kind of progress over the next few years, and probably not get back to 2019 in some segments until 2024.
Thank you, Greg. Appreciate it. All right, Stacey.
Yeah, I certainly agree with Greg in that it's going to vary based on where you are geographically and what asset type that you're in. In certain parts of the country, I would say there's high degrees of normalization in terms of how people are living their lives and how people are traveling again. But in other cities, it's a totally different story. Here in Chicago, we're still seeing really depressed numbers. But that's in the urban center. In the suburban markets, the south suburbs, we're seeing record RevPAR, even greater, 20% greater than 2019. So it really varies greatly over the a geographical and product type. But I will say we're seeing signs. We're also seeing some of the states that are still restricted, pulling back on mask mandates and some of the vaccination requirements. So I think as time goes on, we're just gonna continue to see things get back to normal.
Thank you, Stacey. Bill, throwing this out to you.
Thank you. I would tend to agree with what's already been said. I think that in certain locations, there are signs that we're above what's normal. And in other markets, both geographically as well as segments, we're below historical norms. My own view is fairly optimistic, especially as the vaccines have progressed, as mask mandates go away, and as these new pills come into play. I think you'll see some increases, but business travel is going to be the outlier for a while.
Thank you very much. Paul, please.
Yeah, I would agree with most of what has been said. I do think that it is very sporadic as to what areas are either getting close to normalcy, exceeding it. As an example, if you take a look at the numbers in Miami, the Miami numbers are astronomical. The performance, if you go online trying to book any major brand hotel, even a select service hotel, you could be looking at $300, $400, $500 a night. Ritz-Carlton, St. Regis in the $1,500, $1,600 night. So it's spread. I would say generally the Sun Belt is much closer, if not at normalcy, outside of the urban areas, and in areas where there's more pleasure transient and not as much dependency on business transient. in the Midwest, obviously still very much struggling. And certainly the Northeast as well is still struggling quite a bit. And it's probably going to be a while before those markets get close to being more normalized.
Thank you, Paul. And Ned.
All right, let me unmute. I would agree with what everybody said. It's very, very geographic specific. There's certain markets that are obviously doing much better than others. I think overall, we've got a long way to go in terms of coming back. And of course, my macro concern is we're probably still oversupplied, especially in markets like New York, which have other major structural problems too. So.
You know. All right, Greta, would love for your commentary here, and also take it away, the rest of the panel discussion.
All right. Well, there have been several significant economic downturns over the past 4 years, which I found out yesterday that most of us were involved in. Stacey only was through 2 so far. And with the benefit of hindsight, which has presented really wonderful investment opportunities, does this downturn produce a period that rivals the best in both returns and depth of opportunity? Greg?
Yeah, thanks, Greta. Look, I think it's still a wait and see. You know, as we've kind of alluded to in the initial question, you know, the activity, when you look at the actual numbers, is down versus the prior downturns, which I think somewhat has to do with both what the government did from an infusion standpoint, you know, as well as the banking regulations that really didn't force the banks to clean up their balance sheets, which I think has had some impact. However, you know, as that government funding has dried up, you're starting to see more hotel owners, particularly the weaker ones, you know, finding it a struggle, and you're seeing these hotels come to market. The activity over the last couple of weeks has been extensive. I think, you know, some things to keep in mind is, you know, when you look at the top 25 MSAs in North America, they're still down 33% to 2019 peak, which is fairly significant when you think about it. And as I mentioned before in the opening question, you know, the mid-scale economy, independent hotels are anywhere from 7 to 17% up versus Q4 in 2019. And the reverse of that is luxury, upscale hotels remain anywhere from 9 to 21% down to Q4 of 2019. So I think you can see that there's obviously some challenges, and some of that is based, you know, more directly on, you know, group business as well as transient business. You know, when you look at opportunities, I think they're going to be in the major urban markets, but it's going to take some patience, you know, as these luxury upscale hotels are likely not going to recover, you know, potentially to 2023 all the way out to 2024, depending on the market. When you look at the landscape, you know, REITs, RevPAR on average are still down 40% to 2019, and their stock prices on the trailing 12 right now are still down 72%. So for the most part, while there are some buying, most of them are net sellers. The good news, however, is there's a lot of dry powder sitting on the sideline. As of Q4 of 2021, there's about $250 billion in funds that are real estate focused. So I think you're going to see some of the activity pick up, but I think it'll be, you know, market by market, segment by segment.
Yeah. Anybody else have any commentary on that?
Yeah, I'll provide some insight. This is about as strange a market as I've seen in the 50 years that I've been in the business. I think we all anticipated a huge flow of buying opportunities for distressed properties. Owners that just didn't have the financial wherewithal to withstand the 2 years that we've been in this valley. But it hasn't surfaced, and it's still not surfacing. We're just not seeing any significant volume of distressed opportunities, and those few that do seem to come to the market are not particularly attractive opportunities today, and probably weren't very attractive opportunities 5 years ago or 3 years ago, pre-COVID. On the other hand, we're seeing some assets, particularly newer generation assets, that are selling at astronomical numbers.
Right.
Numbers that are almost, from my perspective, extremely difficult to understand how they're even basing it. And there is a tremendous amount of transactions occurring with properties that are bringing numbers that I don't think in 2019 you would have ever thought you could have gotten then, or in 2022, when even if COVID hadn't hit, I'm not sure that anybody would have expected to see some of these transactions at a per key cost. So from my perspective, it's so disjointed, it's almost hard to figure out what's really going on. Other than the fact that there's a tremendous amount of capital out there that's just being pushed out the door.
Yeah, Paul, I would agree with everything you just said, and I'll sort of footnote something which is interesting. There's all this capital out there looking at real estate, but when it looks at residential or it looks at industrial, it goes, my God, these cap rates are 2, 3, 4%. When it looks at other types of real estate, it goes, geez, I'm scared of office, so I'm not going to go there. And so the only place I'm going to get a so-called alpha return might be in certain locations and certain property types in the hospitality sector. And then you're seeing a lot of pressure on certain types of assets. To your point, I'm amazed at some of the prices, even on properties that are just now being delivered to the market. And then other places where you couldn't get 5 cents for a property because you don't have any faith that conventions are coming back or that business travel is returning to downtown Chicago quickly or whatever your reasoning is. But it's a lot of capital suddenly focused. And what an alpha return is suddenly is, mid-teens on relatively low leverage versus high teens or 20s. And that's because somebody knows, okay, what's the lowest acceptable return I'm prepared to take? And let's say it's 14%. You go, beat that with any of the other real estate types. Not going to happen. So it's kind of, to your point, disjointed, and you got to pick your way carefully. It's like you're coming into a harbor at night, not knowing where the rocks are.
And not having any guidance lights.
Yeah, exactly.
Seth Mandigo, I hope I said your name correctly, asked this question from the audience. At this point, would you say that the astronomical prices hotels are trading for were from 2016 to 17 were essentially a bubble, or do you expect to see a return to the sales of about $600K per room? Did we have a bubble?
That's a difficult question. I honestly think that we're seeing some prices today on certain assets, and a lot of assets, particularly the newer ones that have been built in the last 3 years, that you never would have seen even in 15 and 16. To Bill's point, the cap rates on some of these assets that are selling at way over replacement costs and way over what their investment cost is. A lot of the cap rates that we're seeing are in the 5, 6, low 6s. And to Bill's point, for a lot, that is an attractive investment versus multifamily when you're buying it on a cap rate of 2 to 3 or industrial at the same level. Having said that, though, it's really hard to imagine that if you buy something at, say, at an AC hotel, for instance, at $400,000 a key, that there's going to be that much upside that the thing is going to be worth $600,000 a key in order to get the return. So I don't think that 15, 16 is necessarily a benchmark. 19 sales, 18 and 19 sales probably were a better benchmark.
I think we've had this discussion in the past in many of these downturns many times about what will happen in the future. As the line between hotels and other real estate sectors blur, and hotels are at the risk of losing traditional guests to other lodging accommodations such as Airbnb, and thus never regaining pre-COVID performance levels, they could possibly not regain that. Glenn, what are your thoughts?
The sort of phenomena of short-term stay and so how that was impacting traditional lodging industry segments clearly existed before the pandemic, and in some ways benefited from the desire of people to be in their own place during the pandemic. So yeah, I think there's some continued amount of business that's going to go to the short-term stay segment. But really, what I think the lodging industry has to look at is sort of that kind of permanent disruption that might be in place, not necessarily from short-term stay, but just from the lack of business travel, the fact that we're able to do what we're doing here today on Zoom instead of all gathering in one location where we had to get on a plane and check into a hotel. So that part of it tends to, I think, create the bigger risk of disruption to traditional lodging assets, particularly those in the urban core that are highly dependent on business travel or, the group meeting hotels. An interesting phenomenon that I've seen, over the last year is unlike prior years where developers were taking assets that were used for something else, whether it was office or multifamily, and converting them to lodging uses, the opposite's happening. You're seeing developers coming and finding well-placed lodging assets and saying, how can I convert this to a senior housing facility or something else? And so it's interesting to see how that has reversed, and the dynamic is shifting to take away properties that may no longer be viable as lodging assets, but might have some other repurposed use that's more valuable.
Yeah, thank you. Anyone else?
Yeah, I would just add to that. Look, I think that we've known, through this pandemic that the Airbnb, VRBOs, et cetera, have had success based on the leisure traveler and their interest in getting out. And really, when you start to look at it, travel via car is actually up over previous years pretty significantly. So I think we've seen that. But I think what you're also seeing is a new type of traveler who is really more of a business leisure traveler. And they're willing to pay a higher rate. So I think it'll be an interesting shift, kind of a paradigm shift, particularly for the brands as they start to evaluate their loyalty programs and, where those loyal guests sit now. So I think you'll start to see, it's a wait and see at this point.
Yeah, I think that's exactly right. And the focus on younger people who are hopefully going to get to business travel will be leisure, as they're calling it, for business and leisure. I agree completely. It's all experientially driven. They don't want to go to Granddad's Marriott. They want to go to something that's more got its own identity, personality.
Going for paying for an experience versus having to be somewhere. So they're making selections, or even selecting the property based on where they are. Even in an urban area, you can definitely see them deciding on, do I want the benefit of the experience, or do I just need a night? Stacey, your comment?
Yeah, and I think the line's getting blurrier between the two types. You can find hotel rooms on Airbnb now, and you can find apartments and shared housing on hotels.com and booking.com, which have traditionally been booking agents. And this is interesting. I've never actually booked a room on Airbnb for any stay. I've stayed in them before. I've never gone through the booking process. And for Christmas, I received an Airbnb gift card, which is sacrilegious for someone who is a hotel person, in my opinion. But now that the lines are blurred, they're becoming more blurred. We're seeing that. One of the number one requests I'm getting on feasibility and market studies today is for developing smaller properties that are somewhere in between, that fall into this space that is, highly experiential but low touch, and historically, like that is an oxymoron. How do you get that? And it's this technology that we've embraced over the last 2 years that's allowing that. So as a major leisure traveler, I certainly fall into that demographic, is I think we're going to see that continue to be blurred, but I also think there's still a place for a traditional hotel. You can't have meetings. The business travel, the loyalty programs are going to come back. It's just a matter of when.
What's your
Yeah.
take on travel
just-
prospects? So sorry, go ahead, Greg.
No, I'm sorry, Gretta. I was just going to say, don't forget that pre-COVID, that independent hotels were actually, from a RevPAR growth standpoint, outpacing the brands.
Right.
And, as mentioned before, the independent hotels right now are up 7% versus their 2019 performance. So I think that speaks to at least some share shift that's going on. And then lastly, I think we tend to forget that the Airbnbs, the VRBOs, those are channels. Let's not forget that they act like other channels and did that purposely for what I think you're seeing now.
Yeah, absolutely. Bill, what's your take on the business travel prospects going forward? It seems to be the biggest question mark here, because we know large, big conventions are less than expected in attendance, but there's a huge amount of short-term business opportunities of teams working to get together. So the short-term business from a group standpoint is up. So there's probably a lot of leads coming into these hotels right now. But business travel is probably the most concerning when we're looking at these valuations. So what's your take on that?
Yeah, it's tough to read, as we're all saying about a lot of these subjects, but what I would offer is that in a local sense, in a lot of our local markets, we've started to be able to book small business groups that want to meet as a team. They've been home, maybe they're not in the office yet. So there's a bit of that, but the business travel that says, Bill Reynolds hops on the plane at Washington Dulles, goes to Dallas and has 8 meetings. That isn't happening right now. And then the big group meetings, I have a couple of guys who participate in the Friday night routine call, one of whom is a world-class doctor scientist. And he said, normally I'm going to this conference that would have about 14,000 people, and this year it looks like it may have 1,400. And that's an international conference of really sophisticated medical people. And that's what's worrisome. And the other is that, of course, CFOs have said, gee, maybe we don't need to go to 5 of these things a year. Maybe we'll go to 3. And so all of that comes together in what we hope isn't going to be a perfect storm. By the same token, everybody we talk to, but we're all kind of road warriors anyway, we'd much prefer to be in personal meetings with people in their offices, but therein lies the problem. I mean, in Milwaukee, where we're based, I'm in an office building today downtown here, and it's a 23-story building, and the garage is still pretty empty except for us and one law firm. And I think that's typical, and people are paying their rent, but they're not here. And so until they're in the office, it's going to be hard to justify the kind of business travel that I do or Paul does and so forth. So that's kind of my take. But I'm a firm believer that it comes back, because I just think it's in part human nature and in part relationship building. I don't care what generation you're part of. That's how this really works at the end of the day. But when we're trying to underwrite something, it's very tricky.
Yeah, I tended to agree with Bill on his thought that that the business travel and the interaction is gonna come back to other levels. At the beginning and during the first year of this pandemic, I'm beginning to get a little concerned about the fact that there is a situation that's developing right now where companies are simply don't seem to be very willing to bring the people back to the office because the employees don't want to come back.
Yeah.
And this fear that if you don't acquiesce to their needs, they're going to leave you. And It's concerning to me. I thought that during the first 9 months, 12 months of the pandemic, that business would come back 100%, people in the office 5 days a week, travel would go back to normal. I'm not sure that's going to happen. And it probably not only not sure, it may not really happen. So many companies are just saying people were productive at home. We didn't lose a beat. We're gonna have people come back a couple of days a week, maybe, and that's it. If that happens, that's going to change the dynamic of business travel, because you're just not going to have people in offices to go see, and you're forced into meetings and discussions through Zoom. And so I'm concerned about whether or not demand is going to come back. I'm also very concerned that we're getting to a point where with corporations, with companies, the employee is dictating policy as opposed to the employer dictating policy. And it's for this fear that employees are going to say, I don't want to do it. I'm not going to come to the office. And I'll go get another job. So there, I think there's some dynamics occurring that may not be particularly positive for our industry.
I guess we will see how this all works out this year. Bill, here's another question for you. You've been involved with 3 hotel companies: Marcus Hotel and Resorts, Main Street Hospitality, and Watermark Lodging Trust. These are all very different from one another. How are you looking at the market these days from that lens?
It may sound a little odd to say that's fairly easy to answer. I'll start with Main Street, which is a small boutique company based up in Stockbridge, Mass. that has very cool boutique hotels in New England, all of which, without exception, have done super well the past 24 months, including one that they opened in Newport, Rhode Island, that's 80 rooms and has run pretty much 80-90% since it opened in June of 2020. So that's all leisure and it's all drive-to, essentially. In Watermark's case, that portfolio is happily reinforced by a number of resort properties from Florida to California. And those properties performed well during this period of time and supported the company pretty well. But the urban properties are still a problem, with a couple of exceptions. There's one I'll mention specifically. The Stoneleigh in Dallas held up pretty well because it was perceived as more of a getaway hotel, even though it's quote unquote urban. But if you've ever been there or walked the neighborhood, it's not terribly urban. It's very, very relaxing and fun. And then on the Marcus side, I guess I would say our portfolio has performed very typically, which is the resort stuff from Los Angeles to Vegas to Wisconsin has held up remarkably well. And the urban things have been sketchy or spotty, with an AC performing pretty well, a Courtyard in a different market not performing well. So if it's been business dependent, it's been a struggle. So that's kind of our perception. And so from the Marcus perspective right now, with a capital partner that we just closed in December on a Kimpton in downtown Pittsburgh, in the city proper, our theory right now, to Paul's earlier point, is we would not ignore distress if we saw something interesting, but there hasn't been much to look at that's interesting. Or if you're my age, you can say, why would it work this time? I've seen it 6 times in my career. But by the same token, we're saying this lifestyle trend, as Greg pointed out, was well established before COVID. And so we're saying, let's play into that versus maybe few of the major brand hotels. We have all the major brands, but the lifestyle kind of focus is where we're headed on commercial hotels. And then we'd like to expand our reach in the resort world, not only because people are traveling to resorts, but because we have the skill sets and we should be involved in the Sun Belt someplace. So that's kind of our focus in terms of property types, not excluding the coasts, not excluding distress, but kind of saying we're going to focus on, there's nothing wrong with buying a very good hotel in its submarket, but you have to be careful how you identify those markets. The hotel has to have something special.
Specifically, what type of properties are you looking to acquire these days?
Well, the one I just mentioned is a Monaco by Kimpton in downtown Pittsburgh. We're looking at another one with them. We've always had a streak of independent hotels at Marcus, ranging from the Pfister in Milwaukee, which the company's had as a market leader since 1962, to the Garland in North Hollywood, which outperforms its market pretty handily in LA now that the restrictions are off. And then company has a lot of strengths in food and beverage. So we're more full service oriented than we are select. And then obviously I mentioned resorts.
Thank you very much. Glenn, I'm going to pitch this one to you first. I'd love for everyone to chime in on this. How are changing dynamics and hotel values impacting the negotiations in the hospitality transactions arena these days?
Thanks, Gretta. Yeah, as previously discussed, the industry recovery has been uneven in that some segments, sort of recovered very quickly, and with the amount of capital out there, there's a lot of buyers out there chasing those deals, and as a result, you've got very much of a seller's market for these kind of in favor assets, so that when you're on the purchase and sell side, the terms are very seller oriented in that it's hard money quickly, very short inspection periods and a quick close with very little room for negotiation if the buyer really wants to be able to get that deal. Flip that around on some of the assets that are not as in favor. One, you're just not seeing many of those deals come to market. I think, as Paul said earlier, you expected a kind of a big wave of those, and it hasn't happened. Still a question as to whether or not that's going to happen, as all of the sort of extensions and forbearance and additional kind of money that was made available to prop the hotels up begins to run out. Will you see some bigger wave of those? But on that side, then it's much more a buyer's market where, to the extent sellers are in a position where they have to start selling assets, the buyers are going to find more favorable terms. So it's not a one size fits all, scenario by any means.
Anyone else? All right,
Yeah.
I'm going to go. Oh, so go ahead, Greg.
No, I was just going to add. I think Glenn is spot on with that. I think that you're seeing a wide bandwidth of things. We recently put a resort under agreement. It's about an hour 15 outside of Boston, right? And we did it for obvious reasons. But this is a resort that was operated by the owner, and so the point that I would make to that is that I think that there are these type of challenges where you have owner-operated assets that just don't have the girth or the wherewithal or the human capital to be able to execute in this marketplace. And as you start to think about it, there are going to be some value opportunities if you search them out. And I will reiterate again, activity on actual hotel transactions are down versus the last two downturns. We're starting to see an influx, here kind of in February. So it'll be interesting to see, but there are opportunities out there to buy value.
There's a lot of available capital, but not a lot of assets to to use it for. I'm sure you guys are excited to see that the assets come back on the market. Greg, I wanted to go into hotel management companies, and from Victory Hotel Group standpoint, we know that hotel management is probably more important now than ever. So how are we regarding that in relation to asset value, and has the consolidation of large companies such as Aimbridge had any effect on the state of values?
Yeah, it's a great question. We acquired a company called Hay Creek with now up to about 30 hotels, which focuses on independent boutique hotels, mid-year last year. And so, we're getting a good line of sight into, at least into that segment and what's going on there. I think one of the things we have to remember is that one of the things that's occurring from the pandemic is we're seeing a real rise in costs, right? Rise in materials, rise in labor, union costs going up, staffing issues and challenges. Some of that is going to come in effect, pricing as it relates to replacement costs. But I think more importantly, you're going to need companies, these larger management companies, to be able to bring innovation, technology, robotics, other things to the table to help, these assets be able to, compete. I also think you're going to need to see the brands, revisit their service standards and look at what's really necessary. What can be modified, improved, innovated around from a technology standpoint to deliver something similar. And I think you'll start to see that. I would argue that the consolidation is likely good for owners. I think it provides these larger management companies an ability to negotiate more aggressively with the large brands, to bring to bear, a much, wider bandwidth of vendors. And negotiate at a much higher level based on their purchasing power, and I think that's all good for the owner and the owner's asset. I will say that competition is always a good thing. So you have to kind of take them both at the same time and understand why this consolidation occurs, and I think it will ultimately net deliver more value for owners. Competition can be something that's good for the industry as well. I was going to ask you, Gretta, what are you seeing from brands and kind of how they're positioning themselves?
Yeah, we're working with quite a few management companies that are really focused on the staffing issue. It is it's the main issue. I mean, 80% of your budget is your human capital, so it's just going to be a cause of problem. So your lack of staff is going to affect service standards. Your lack of experienced staff, these skills, hospitality skills were translatable, which is great, but not so great when we want to get them back because they already planted someplace else. So really it's the focus on attracting talent and creating a culture that people want to be part of, and then training and development. And I'm seeing a lot, we can certainly say that a lot of companies are focused on the development programs that have a lot of meat on the bone right now, and they're doing it right. You can see they're actually doing quite well. So, it's the staffing shortage is the highest priority of every single company. It's very challenging. I know, Stacey, we talked about this a little bit yesterday. Did you have any feedback on that?
Yeah, and it's something that we hear every time we go into a hotel is staffing. It's an issue. There's not enough people. But we did. HLA just announced that they are launching a new program to help educate hospitality as a career. So the fact that you can start as an entry-level position and then make a career, become a manager, general manager. And in some cases that leads to hotel ownership and these, a lifelong career in hospitality, as so many of us, like I grew up in restaurants and worked in hotels in college. And like, this is how most of us end up, being in this career for a really long time. So hopefully that'll be a really good boost in terms of education in order to attract people to our industry, as, we're losing out in some cases to Amazon and these other companies that offer benefits, additional benefits and training and things like that. So we'll see. Hopefully that can make headway.
Or allow you to work in your pajamas all day if you choose. So that can cause a bit of a problem because the remote workforce is definitely growing. In fact, offices are just closing and they're allowing their workforce to work remotely indefinitely. And they're not saying when they're going to come back. They're saying, nope, you're able to work wherever you want remotely. So that will cause some short-term group opportunities. But the problem with that is attracting talent into our industry. They have to see this as what it is. It's a great opportunity to learn and grow and see business. You're really an entrepreneur. So it's a wonderful opportunity. I think we need to certainly market that more and make sure we have these development programs. We're working with actually Dallas College right now and many universities on emerging leadership certification programs. So it's really exciting that communities and workforce development grants are really being provided to help some of the training opportunities. So there's certainly a focus on developing the workforce and attracting the workforce, but it's going to be a lot of hard work this year for sure. Anyone else have any feedback on that?
Well, and not to mention the increased cost of, attracting and retaining that, that labor, and that, ends up impacting, the bottom line of hotels that may already be struggling, given, the lack of some, segments of business.
Well, the flow through is going to be very challenging if we keep, doing things the way we used to. So those traditional models of how hotels ran before, the innovation I can see right now. In fact, next door to us is a gentleman that runs a company with robots for restaurants. So I find it funny that he's right next door to us. We chit chat about that. But the innovation is coming out. We saw it, popping up all over the country in little spots, and it was really cool and fun. And then COVID came, and we realized that we could read a menu on our phone with a QR code. But the innovation has really advanced. What are you guys seeing, or what are you hearing, and what are you most excited about with the innovation so far? Or not?
I don't know if excited is the right word. There are companies that are experimenting, obviously, with robotics for all kinds of things, from cleaning bathrooms to, I remember years ago at Thayer, we had this desire to do a robotic banquet kitchen, which proved to be too expensive 20 years ago, but maybe not today. But there's going to be a lot of this, and obviously front desks are already disappearing. You may have greeters, and depending on the type of hotel, but clearly there's change underfoot, because to your earlier point, 80% of your operating budget is human capital. By the same token, I'm still one of these stodgy people that when I go to the Whole Foods store, I refuse to check out on my own. I want to preserve a job for the person. Same thing at airport parking lots. But I'm not sure I'm going to win any of those battles. But there's clearly going to be a lot of innovation in our business.
Yeah, and I would add to that I think that you're going to see some innovation around job sharing. I think that's something that's critical and important to the industry. If you can,
Right.
You can take people that are housekeepers and have them job share with someone on the front desk. I think it elevates everyone, which is
Yep.
a great to be able to see. And I also think that you're going to see workforce housing become more important in proximity of particularly urban hotels. And maybe a great way to solve hotels that have seen their useful life. So I think you're going to see innovations around that and education that will also help the industry.
Yeah, great points.
Yeah, I think the resorts, I know many that have to actually, create their own bench strength. And so getting back to having bench strength and growing a pool of team members is going to be a critical component of to the strength of a management company, because they're going to have to be able to deliver on their promise to you, and they're going to have to be able to perform and engage those team members as well. So there's a lot of work to be done. That takes us to the flow through, which is, although the US RevPAR is recovering and a bit in occupancy, a bit in ADR so far, GOP per available room is still suffering at 73%, and costs are continuing to rise. So how are you factoring it into the future of asset values?
I think I'll take this question, as valuation is my primary role in this industry. I think this is something that we're seeing and having to really focus in on, because 2019 expense levels are no longer valid in a lot of cases. It's the data that we have to use in a lot of situations. What we're doing from a valuation standpoint and underwriting and trying to project out income and expenses going forward is taking a really close look at what's happened over the last 6 months. Where have expenses been cut? Are those cuts sustainable? Are we going to continue to be able to operate these hotels with only one sales manager and a reduced team and reduced front office staff? Or is it going to have to come back when occupancy improves? And what are the changing labor costs? The state of Illinois is, in the process of mandating a minimum wage increase across the entire state, and even greater in the city of Chicago and the city limits. So we have to look at these things as we're going forward, and not to mention inflation and baking in an underlying inflation rate that takes into account the rising cost of everything. Going grocery shopping, it is somewhat shocking when we go through and you're like, things that used to cost this much are now, something you never expected to pay. But that same thing is going to apply to, everything we see sourced in a hotel. So it's definitely something we're looking at and very closely, trying to use as much recent data as possible to project going forward, and looking at each hotel individually and their situations.
So how are you, Stacey, underwriting for occupancy of RevPAR, taking into account the inflation aspects that we're seeing right now?
Right. So we're seeing major rate inflation in every market. And, occupancy obviously is going to be on a property by property basis, depending on the location and these things we've talked about already. But ADR inflation has been really huge in just about every market I've worked in. And I'm primarily in the Midwest, but I know we're seeing this nationwide. And so when we're looking at the last 6 months and seeing ADR increases of anywhere from 10 to 15% over 2019 levels, those same months, number one, it's really encouraging to see that, okay, we're going to make traction, RevPAR is going to increase. And historically, hotels, when they've been able to grow rate and gain RevPAR margin using rate over occupancy, you see a much stronger flow through to the bottom line. However, what we're seeing now on a national average basis, that's not necessarily the case. And let's remember, hotels are still offering really limited amenities and food and beverage and limited housekeeping. And so these services that all cost money from a labor and expense standpoint, are we going to have to return to that? Is the consumer going to pay $800 for a room and not have daily housekeeping? Is that okay? Or are they okay with people no longer coming in their rooms? So I think that's also one way hotels are going to have to be creative in terms of, do I offer a give back and points and things that were in place before, but no one was really doing, because it's difficult to manage. So having the technology in place to do those things. But as we're projecting out expenses, we're taking inflation into account on all sides.
Seems that the interest in room rate is still high for a high room rate with low service. So the appetite's still there for the quality of product, but when is it going to turn when the service delivery doesn't match the level of expectation? Are we
right? I can tell you, as a consumer, my patience is wearing a little thin. For the first 12 months when I was staying in hotels, it was okay. The industry is not recovered. They don't have staff. We don't have, you walk in and see signs, be patient with us. We are understaffed. And so, of course, you have sympathy and compassion for that and the employees that are coming to work during this pandemic. But it's now, okay, well, that was great when I was paying, 100, or a 20% discount on that room. But now I'm paying a 200% premium on that room. And am I okay with not having these extra services anymore? Or am I going to try to seek out these experiences that either that's included, or I'm calling hotels to see, are they offering these things? And I think that's certainly I don't know that I'm in the minority there in terms of wanting more for your money.
I don't think you are either. But there's a certain point where, that is going to be an interesting situation for our revenue manager team members out there to really harness this and really understand how far they can take that, for sure. Thanks very much, Stacey. All right, last question. We're wrapping up here, so I'd like to hear from everyone. Should real estate values or hotel values continue to benchmark against 2019? I'm going to ask Glenn that question first. I know you all have an opinion on that matter. Don't know if Glenn's still there. I can see.
I think Glenn's frozen.
I think he's frozen.
I'm here. Sorry, I
Oh,
feel
there we
like I'm living one of those commercials where your video freezes. So I don't know if you can hear me or not, but it's one of those great lawyer responses. It depends. If it benefits you to benchmark against 2019, then you'll do so to show how you've more than fully recovered from the downturn. However, if you're still below 2019 levels by a fair bit, then you're probably going to be benching against 2021 to show how you've improved.
Yeah, definitely.
Look, I would that a little bit and say, look, 2020 is a mess, right? I mean, you're not going to get anything out of 2020, and 2021 still isn't really clean. There's still a fair amount of noise in there. So at this point, at least when we're valuing hotels, we're having to use 2019. And, if that means we don't win the bid, we don't win the bid. But I think it's really difficult right now to use 2020 or 2021 in most cases to be able to value a hotel. And as I said earlier, remember, a lot of these hotels in North America and the major MSAs are down 33% to their 2019 performance. So it's really still the benchmark. And Stacey probably knows this better than I do, but that would be my comment on it.
Yeah, Greg, that's absolutely right. In major markets, in Chicago, we'd love to be 33% down. We're much larger than that here in the urban center. But we, as appraisers, we use data. We're all data driven. And so we have to use the data that's available. And 2020 is not good data. It's an outlier. We would throw it out as a data point. And so 2019 is still the best benchmark for us. But as time goes on, as I mentioned, when we're looking at as much of the trailing data that's good and starting to show a recovery as we can. And so that whether it's trailing 6 or trailing 9, in some of these really strong performing markets that you all are in the South, trailing 12, obviously we always want to use the recent data, but in some cases it's just not useful. So we'll probably still see 19 as a benchmark, so at least from a valuation standpoint for a little while longer.
Yeah, from my perspective, I think that 19 is still the best year to benchmark, but I will caveat that you have to look at it market by market, because there are certain markets where 19 may have been unusually strong for some reason, maybe a Super Bowl or something like that. There could be markets where 19 we know of one market where we have a hotel in suburban Atlanta where in 19 there was a tremendous amount of renovations going on in hotels, and so the numbers were extremely distorted for that. And in that case, we've gone back and we're benchmarking where do we think we're going to go going forward, more based on 18 sub-market numbers than even 19. So I think you got to look at each market individually and not just say we're going to benchmark to 19 without understanding what happened in 19 in that market.
Yeah, and Paul, I would add to that, it's an interesting perspective. When we look at our owned existing hotels that we owned from, say, 2010 forward, we're still looking at 19, and we're still looking at the market specifics you're talking about, because now's the time to reinvest in these hotels. And then when we're looking at buying something new, you've got to benchmark against something, but it's all subject to the market in 2019. And to Greg's point a little while ago, I just treat 2020 as my Rip Van Winkle year. I was just gone for that period of time.
I think we're all with you there, Bill.
Right.
Ned, any parting words?
Well, no, I was going to say 2019, I think in retrospect we're going to look back and say that was probably a peak year. And it's certainly individual markets and individual properties you've got to look at them in detail. But, my sense is that was the party hardy year, and I don't know when that comes back. There are some encouraging signs. I was down in San Diego for the MBA conference earlier this week, and there were quite a few people there. I don't know what the exact attendance was, but it was strong. It certainly wasn't what it has been in the past, but certainly it was good to see people were out. Everybody was literally partying, and no masks. And for the most part, it was we were back to the races. So that's encouraging. I think that's going to, probably continue to recover. I still believe that the market is, on a macro basis, just horribly overbuilt. And I think in certain states and cities where there's a huge regulatory burden and no flexibility as to pricing of labor and everything else, you're really looking at a tough go like Chicago. Stacey is, something that, we've looked at a lot of stuff there because there seems to be a lot of product available, but there's a lot of product available because people have had it. And my sense is this year, we're going to see a lot more of the distress that we thought we were going to see 24 months ago. So we've been waiting, and we'll continue to wait, probably look and wait.
That's a good way to end this. Thank you, Ned. Thank you, everyone. This is a very interesting conversation, as it always is. This is a very interesting time, and honored to be on a discussion panel with each one of you because you offer such insight. Thank you to our audience that chimed in. We're getting a lot of love notes, and I know Andrea has been answering them rapidly, and all of you have been. We will be sending out a summary for everyone who registered. We'll be sending out the full audio and video of this so you can share it with your teams. I think it's really important, interesting information. And in summary, I think Glenn said this yesterday once we went through a preliminary discussion. It sounds like the recovery just depends. It will just depend. So we have to be smarter, sharper, more innovative, more creative, and be really mindful of both the costs and making sure that we're acquiring the right revenue and making our focus in the right place. So it's going to be a year of hard work, but I know that our industry is up for it. So it's exciting to see what happens. So we'll come back in a few months and check in and see how things are progressing. Thanks, everyone. Appreciate your attendance.
Thank you.
You're welcome.
Thank you, Gretta.
Thanks, everyone.
Thank you, everyone. Have a fantastic day. We look forward to seeing you all again, and appreciate all the commentary, the feedback, and especially thank you to our expert panel. Everyone have a great day.